Hey everyone, we've just received a critical update from the high-stakes negotiations in Pakistan, and the news isn't what the markets wanted to hear. Vice President J.D. Vance officially confirmed that the talks between the U.S. and Iran have ended without a deal, effectively shattering hopes for a long-term agreement. This means the fragile 2-week ceasefire we saw earlier this month is now hanging by a thread, and the implications for global energy are massive. In today's deep dive, we're going to break down exactly why oil remains stubbornly high and what this geopolitical collapse means for your portfolio. Let's look at the current price action. Crude oil, specifically WTI, is still trading remarkably close to that $95 resistance mark. Instead of the pullback many expected, we are seeing a heavy war premium being baked into every single barrel as diplomacy fails. The strategic focus remains on the Strait of Hormuz, the world's most critical oil choke point, where 20% of global supply passes daily. Any threat to this region is a direct threat to global energy stability, and the failure of talks in Islamabad increases the risk of naval escalation. To understand this volatility, we have to look back at history. Every major Middle East conflict has led to a sustained floor in oil prices that lasts months. We are currently seeing a pattern similar to previous shocks, where geopolitical tension creates a structural shift in how the market values energy. Looking specifically at the inventory data, global crude stocks are at multi-year lows, leaving virtually no buffer for supply shocks or production outages. This lack of strategic reserves means every diplomatic failure triggers an immediate price squeeze as refineries scramble to secure long-term supply contracts. For traders, this creates a very specific environment. You need to be looking at the energy sector through the XLE ETF right now. Industry giants like Exxon and Chevron are seeing sustained interest as they act as natural hedges against this growing geopolitical volatility. On the flip side, tech and growth stocks are feeling the heat. Higher oil prices translate to higher production costs and lower consumer spending. This creates a dangerous feedback loop with inflation. As we saw in the recent 3.3% CPI print, energy is the main driver. Now let's get into the technical levels you must have on your screens this week. On WTI, $95 is our immediate battleground. If we sustain a break above 95, the market will target the $100 psychological barrier almost instantly. A clean break above $100 could trigger massive waves of algorithmic buying, potentially pushing prices toward 110. We also have to consider OPEC+. Their decision to maintain production cuts amid this crisis is keeping the supply side of the equation extremely tight. With global demand still recovering, any further supply disruption from the Middle East will have an outsized impact on the price per barrel. Furthermore, watch the tanker freight rates. As risks in the Persian Gulf escalate, insurance premiums are skyrocketing, effectively adding a hidden tax to oil. This logistical bottleneck is a secondary inflationary pressure that often goes unnoticed by retail traders, but directly affects the final price at the pump. Discipline is non-negotiable here. High volatility markets like this are an opportunity for some, but a disaster for those trading without a plan. I strongly recommend tightening your stops on any broad market positions. Geopolitical headlines move too fast for unhedged exposure. Consider reducing your position sizing if the VIX remains elevated. It's better to stay in the game with smaller wins than to be wiped out by one gap. Information moves at the speed of light. You need to be monitoring real-time data terminals for any news from Tehran or Washington tonight. One headline about a drone strike or a shipping blockage can move the S&P 500 by 2% in a single trading session. Personally, I am maintaining a very cautious stance. I'm holding my current energy positions, but I'm not adding new equity longs today. I want to see more clarity from the ceasefire situation before committing more capital to the broader market sectors. Keep a close eye on the dollar index as well. A strengthening greenback combined with high energy prices is a toxic mix for emerging markets and global trade. If the DXY breaks its recent highs, we could see even more pressure on risk assets across the board, potentially dampening any recovery in stocks or crypto. Don't forget the crypto angle. Bitcoin is holding its $71,000 level remarkably well, despite the traditional market tension. More institutional money is viewing Bitcoin as a potential digital hedge against the combination of inflation and geopolitical instability. To recap, watch 95 on WTI, keep an eye on energy sector momentum, and most importantly, protect your capital with tight stops. What do you think? Will we see $100 oil by Friday, or is this just another round of diplomatic posturing before a deal? Drop your prediction in the comments below. Are you bullish on oil or expecting a correction? I read every single one of your thoughts. If you found this breakdown helpful for your trading strategy, make sure to like this video and subscribe to our growing Academy channel. Hit that notification bell for our next macro update. We'll be back tomorrow with more insights. Trade safe, follow your plan, and I'll see you in the next one.